Hey, I'm Manny Apollonio. I'm a certified financial planner, potentially your certified financial planner if you play your cards right. And I'm a financial life coach, potentially your financial life coach if you play your cards right. I'm only kidding. I'm only kidding. I am here because I am wanting to share with you some knowledge. I've got a little bit of it. Some knowledge about a key financial concept. So today I want to talk to you about a mortgage. If you are looking for a home and you're planning on borrowing some money to pay for that home, you're going to want to watch this video because it's just a really quick and easy way to understand how mortgages work. First, how fun that you are looking to buy a home. This is super, super duper fun. One of the first things you'll need to do when working with a realtor, they're probably going to ask you to get what's called a pre-qualification letter from your lender. There are plenty of options for mortgage lending, and your realtor will definitely have some recommendations. Now you have a lender. They're going to ask you to fill out a bunch of paperwork. They want to know how much money you have saved in the bank, how much you have money saved for a down payment. They want to know what your credit score is. The credit score that a lender is going to pull is going to be different than the credit score that your credit card issuer pulls from the credit bureaus. Part of the calculation in determining what you can afford as a borrower is taking into consideration your debt to income ratio. Essentially, the lender wants to make sure that when you have satisfied your mortgage payment, you have enough money left over to also pay off your other loans, student loans, credit cards, private loans, car payment, what have you. They want to make sure that you have enough money to live in addition to paying off your mortgage. You're less likely to default or less likely to stop making payments if you can afford it. Part of calculating the debt to income ratio is calculating how much the mortgage payment itself is going to factor compared to your income. So typically, most lenders will lend up to 36%. So the payment for your mortgage should not equal more than 36%. Depending on the lender, they might go up to something like 40%, including the mortgage and all the other loans and payments that you make within a month. All of those payments should be below 50%. Now, there are ways that you can improve your debt to income ratio, and that's one, you can increase your income, or two, you can decrease the amount of your recurring payments. Here's an example. If you have a car loan or a car payment, for example, for $500 a month, and let's say that you only have 6 more months of payments, if you wait to apply for your mortgage after you've paid off the car, your debt to income ratio will look a lot better because now you have $500 more available towards servicing your debts, and so therefore your debt to income ratio can come down. So it might behoove you to pay off as much debt as possible before you apply for a mortgage. What you want to achieve here is a lower debt to income ratio. Here's an example of calculating the debt to income ratio. Let's say a person earns $8,000 a month and all of their monthly recurring payments of loans and other credit cards comes out to about $2,000 a month. That means that this person's debt to income ratio is 25%. 25% of their monthly income goes towards servicing those debt obligations. Another key concept to understand here is collateral. Essentially, it means this. The bank is saying, hey, we'll lend you the money to buy this home. The collateral or the property that we will take to secure the loan is the home. So if you default, meaning if you stop making payments on this loan, we will step in, take possession of the home and sell it so that we can recoup our losses. Collateral helps to reduce the risk for the lender, but the lender doesn't want to go through the process of having to kick you out of your home and sell it. So they want you to have skin in the game, which brings me to a down payment. A down payment is kind of a little bit of your proving to the bank, to the lender, that you are in it. You are committed to paying off this mortgage. You're committed to buying this home. The idea being that if you default on your loan, you'll also lose your down payment. And if you bring 20% to the table, let's say on a $200,000 home, that's $40,000 you're leaving on the table. So it's in your best interest to make good on your word and continue to make payments to satisfy your mortgage. Typically, people talk about 20% as the amount that they're willing to bring to the table. Anything less than that, you start getting into territory where private mortgage insurance is required. Part of obtaining this pre-qualification letter is to prove to your realtor that you're serious. They don't want to show a bunch of houses to someone who isn't even qualified to buy the houses they're being shown. A good realtor will walk you through each one of the steps that are required to purchase a home. And if you're working with a realtor who seems to be a little bit impatient with you because you are a first-time home buyer, guess what? You are the consumer. You do not have to do business with that person. Here, I gave you permission to look for a new realtor, one that is sensitive to your needs as a first-time home buyer. Okay, so now you have your pre-qualification letter. Your realtor has that in hand. You now have a budget, and let's say you've found your dream home. You make an offer. The offer is accepted. For easy math, let's say the house is $200,000 and you want to put 20% down. So you do the math. What does that come out to? That's $40,000 that you're going to put down from either your savings account. If you're taking money from your 401k, there's a little bit more nuance, but there is a penalty. So when you take money out of the 401k, IRS says, hey, that's income that you said you were going to take in retirement, but now you're taking it now in present day, and you're not retired yet. So we're going to charge you a penalty for taking it out early, and we're going to charge you income tax because it was never taxed. Such is the sacrifice one makes when trying to buy a home. But if that's the source of your down payment, think of it as like a diversification play, meaning that instead of having all of that money that you had in your 401k in the stock market, you've now diversified a little bit and put it into real estate. Okay, so now you have a home, a $200,000 home. You've determined that you're going to do 20% down, so that's $40,000 that you've determined will come maybe from a combination of your savings and your 401k, what have you. Now you're looking at some terms, loan terms. These are very important to understand. There are different types of mortgages. Most first-time home buyers are going to want to purchase their home on a fixed interest 30-year loan. So that means they're going to take up to 30 years to pay off their mortgage. They're going to request a fixed interest amount, which means that the interest rate that you sign up for on day one of having your mortgage remains the same amount through the entire length of the mortgage. When you are shopping for a mortgage, you're going to be looking at different rates. Typically, they're expressed as an APR, which is called an annual percentage rate. So the money that you borrow, and in this case, $160,000, if we're doing 20% down on a $200,000 home, the $160,000 is going to be subject to this annual percentage rate. You're going to start out on one end with a lot of interest, and maybe a little bit is going towards the principal amount of your loan. In this case, $160,000 is the principal amount. It might be that you are paying quite a bit of interest and just a little bit of principal in the beginning of your loan. But as the years go by, these are going to switch, and you're going to be paying more principal and less interest over time. The magic of all of it is that if you are paying down this mortgage, the payment stays the same throughout the entire length. You have to make those minimum mortgage payments, but you can pay more if you want to pay for your mortgage quicker. When you have paid all of the mortgage off, the bank that has lent you the money will go to the county and say, hey, this person has paid off the loan. We're going to remove the lien from the property, and we're going to give the deed to the homeowner because they are now the rightful owners of this property. We no longer are involved because for our purposes, the loan has been satisfied. So when you sell a house, that whole transaction is kind of fast forwarded with an amount from the sale of the home going towards paying off the mortgage. Hopefully that was helpful. It's just like a brief little primer on how a mortgage works. I'm going to go in more depth with this concept with the help of a professional lender in another video, so stay tuned. Thanks for being here. I'll talk to you later. Bye.